All right, hello, good afternoon, everyone. My name is Haita. I am a class of 22 global health graduate from Rollins, and I currently work at the Rhode Island Department of Health. And my position currently at the Rhode Island Department of Health, I work as a disparity specialist. And today I'll be serving as your host for today's webinar, Life After Rollins, Building a Strong Financial Future. So for those of you who have joined us earlier in sessions a part of this series, welcome back. We're so glad to have you. And for those of you who it may be your first time, we welcome you to Life After Rollins, a life-oriented series created by the Rollins School of Public Health Alumni Board as part of its recent graduate subcommittee, which I am a part of with fellow alumni Elena Jordanov and Trish Miller. Although this series was designed with recent graduates and early career professionals in mind, we welcome everyone who is seeking tools and information to help them succeed in their lives and careers. In December, as I mentioned earlier, we have hosted two sessions, one of them focusing on job search and another session focused on salary negotiation. Today, we will be discussing ways to improve your financial health and to feel more confident about your financial future. So before we begin, I just have a couple of housekeeping items. So today's session will be recorded and the recording will be shared later on our Rollins website. If you would like to just come back and view it again. We also welcome all of your questions. Please feel free to use the question and answer section of the chat to just input any of your questions, and we'll address all questions at the end of the session. And then also, please keep your microphone on mute throughout the webinar unless otherwise requested. And now introduce our speaker, John McColl. John is an Oxford and Emory alum, earning his finance and accounting degree in 2010. After graduation, he worked for a Big Four accounting firm as a financial statement auditor where he specialized in taking companies public. Now he is a financial advisor working with clients to build wealth and plan for their financial goals. He is very passionate about helping people reduce their expenses to achieve financial freedom. We're delighted to have John here with us today. John, welcome and thank you for joining us.
Thank you for having me. Where I like to start my presentation is really focusing on people's savings rates and the importance of their annual savings rate. And so if you look at this graph that you're seeing right now, what this is showing is basically if somebody were to save 5% of their income per year, how quickly could they retire? How many years would they have to work? And up here, you'll see that it says 70. So basically, if you save 5% of your income per year, you'll have to work for 70 years to be able to afford retirement. And so this is a really good analysis to help people understand that basically, if you're saving a very low percentage of your income, then it can require you to work a very long period of time. Alternatively, let's look at somebody that's saving 30% of their annual income. They would actually only have to work for 28 years to be able to afford retirement. And so if we look at this analysis right here, what's crazy is the average American is saving 5% or less of their income per year. So this is basically saying that the average American is going to have to work the bulk of their life to be able to afford retirement because they're only saving 5% of their income per year. And so this shows that people will need to save a higher percentage of their money compared to the average American if they want to get in a good financial shape. And so it's very important to understand how you can go about increasing your annual savings rate, because that's one of the biggest determining factors in your ability to be able to retire at a younger age and not have to work your entire life. Lastly, if you see up here in the corner, I said percent of life for men and women. Women tend to live slightly longer than men. And so a typical man that lives based off of life expectancy would have to work 94% of their life to be able to afford retirement if they only save 5%. And for a woman, it's 87.5%. And so this really hits home how important it is to save at a higher savings rate and tracking that because that's one of your best metrics to determine if you're on track to afford retirement or not. So one of the things that is so important is most people that have graduated from Rollins are going to be younger, so they have a ton of working years ahead of them. And if they're able to save money when they first start working, that money can grow to a tremendous amount because that money could be invested for the long term. So right here, what I'm doing is I'm saying, let's look at somebody that could invest $7,000 today when they're 25 and see how much that money could grow to. So I'm saying they're able to save $7,000 and they would get an annual return of 10% per year. The reason why I'm using that is the stock market has actually returned 11.66% per year in the long run. You can see periods where the stock market loses 50%, but there's also periods where the stock market has made 60%. It's all over the place in a single year, and I'll show that in a second. But in the long run, people have made about 11.66% per year. So annual returns of 10% are actually lower than historical stock market returns. So let's see what that $7,000 turns into at the time of retirement. So what this is saying is at age 67, that $7,000 at 10% return per year has turned into $383,346. So just that one investment of $7,000 has turned into $383,346. But let's say you do another investment when you're age 26 of $7,000. That next investment, by the time you're 67, if you don't touch it, turns into $348,496. So let's say you continue to do that, age 27, age 28. By the time, just those four contributions of $7,000 between the ages of 25 and 28 has turned into over $1.3 million. And the reason why I focus on $7,000 too is there's this account called a Roth IRA, which means you pay taxes today on the money before it goes into this retirement account. But as long as you don't touch it until retirement, you'll never have to pay taxes on your earnings. And so if you were able to put that $7,000 away in a Roth IRA, that $1.3 million will not be taxed because you put it in an account that has this favorable tax treatment. And so that's over $1.3 million of earnings because you put in $28,000 in this example. You had over 1 million, like 1.3 million in earnings, and you'll never be taxed on that money because you put that in a Roth IRA. Now, it's important to know that if you put that money in there, you're not supposed to take it out. The earliest you could take it out is 59 and a half. So it's very important to keep that money in there for the long term because that's how you get the favorable tax treatment. But if you're able to do that, that, as I'm showing here, it can grow to a tremendous amount of money. So in my next example, what I like to show is the importance of time and the importance of your annual return on investment. And so what I'm showing here is in the orange example, we're looking at somebody that got a return of 10% per year. And in the gray example, we're looking at somebody that got a return of 5% per year. And they're both doing an initial investment of $7,000. So let's go to the 40-year time frame here. That initial investment of $7,000 turned into $316,815. We're at the 10% return per year. But if you look at the gray example where somebody only got 5% per year, that $7,000 only turns into $49,280. So what this is clearly showing is that if you're putting a money away for the long term, and you don't get as high of return, it can have significant impacts on how much that money grows to. Because this grows only to less than $50,000, whereas the higher return example grows to close to $317,000. Just crazy to see how big of an impact a lot of time can have on the investment. And on top of that, how the annual return percentage can have such a huge impact too. So let's go down here to the 10-year time frame as well. After 10 years, you're only seeing about a $7,000 difference between the 10% and the 5% return. But after the 40 years, you're seeing the giant significant difference there. And so when you're young, it shows how important it is to save money and invest it in something that's going to earn a higher return for you, because over the course of your life, that 40-year time frame, it's going to turn into a tremendous amount of difference there. That's almost, I don't like to do quick math off the top of my head, but that's over 200 and almost over $260,000 of a difference between those two numbers, and in that 40-year time frame, because the returns were so much higher. So just to reiterate some of the points that I've made earlier, is that your savings rate is so important, and how wealth is portrayed in the media, on social media and things like that. You'll see on the left here, you expect wealthy people to be driving Ferraris or fancy sports cars. You expect wealthy people to be living in these mega mansions. But actually, the typical wealthy person, the typical millionaire, they drive a Toyota Camry, and they live in a slightly below average size home. And they were able to save a tremendous amount of money by living like normal people. And that's how the average wealthy person, the average millionaire, became financially successful, is actually living slightly below their means, living like everyday people. And that's how the majority of people build wealth for themselves. Right here on the left-hand side, if you want to live that lifestyle, you have to be a billionaire, basically. That's how most people can afford a lifestyle like that, meaning you had to create your own business, and your business becomes very successful. That's how people become billionaires. But if you want to be, a typical employee, you're going to have to live slightly below your means. And by doing that, you'll be able to save a tremendous amount of money. So you live like an everyday person, where you're not spending too much money, living below your means, and that will build a tremendous amount of wealth for yourself over time. So what I'll stress too is the most important wealth factors that we're seeing is your ability to earn an income from working. And so you want to make sure you're in a career where you can stay in that career for the long term, you enjoy that career, and so that you'll continue to show up every day to earn that income, because your work income is your best asset, your ability to generate income based off of your effort. Making sure you have a high savings rate, as we had talked about earlier. And so that means you got to figure out how to lower your expenses compared to typical people. The length of time investing, and also making sure you have high annual returns. Those are the 4 factors that if you can do well at those 4 things, that means you're going to be able to get yourself in a good financial position. So one thing too, to understand, that sometimes it doesn't make sense to invest your money. If you have high interest rate debt, it can make sense to go ahead and pay off that high interest rate debt. And I'll walk through an example in a second about how to prioritize either paying off debt or investing. And so I want you to understand that sometimes it can actually, your best investment could be paying off credit card debt or other high interest rate debt, because that's going to be your highest return on investment. And so it's very important to understand that that sometimes is a really good investment as well, is paying off debt. Now, companies, when you go to work for different employers, you could have a 401k, a 403b, a thrift savings plan. Those are all the same things, just different words that describe the same thing. A lot of times, those employers will have company matches. So if you put money into a 401k, they might match 3% of your salary. And that could be 100% return on your investment, meaning that when you put 100% of your money put 100% of 3% of your salary in, they're going to give you 3% of your salary in that 401k. And so that's because the stock market returns a little over 10% per year. Like I said, 100% is better than 10%. And so I want people to take advantage of those company matches, because that's one of the best returns on investment that you'll ever see, is when companies are giving you 100% return on your money by putting that money in to like a 401k, a 403b, or a thrift savings plan. Another thing that's very important is establishing an emergency fund. Usually we say 3 months worth of spend is the minimum amount of money that you want to have in a savings account. So if you had an emergency, you have the cash to pay it off instead of putting that on credit cards that are at really high rates above 22%, because it can be very difficult to get out from under that. And so it's very important to establish an emergency fund where you have at least 3 months worth of spending in a savings account, just in case you had an emergency, you can use that money. And then once you've done all the things where you've got rid of your high interest rate debt, it can make sense to start investing, where you put every paycheck, you can put money into the stock market. And so I did want to talk a little bit about how the stock market works, just so people understand why the stock market has been very good over time. So what this analysis is showing is that it's showing how stocks have outperformed bonds over time, over different holding periods. When you think of bonds, they return similar to savings accounts. So think about how this is comparing what stock has done based off of how long you held the stock compared to a savings account. And so what you'll see here is, if we look at a 1-year period, in modern history, stocks have outperformed savings accounts over a 1-year period about 61.3% of the time. But if we go all the way down to 30 years, if you held stock for 30 years, it's outperformed a savings account 99.3% of the time over those 30-year period, over any 30-year period in history. And if you compare it to government bonds, it's outperformed the government bonds 100% of the time in modern history. And so what this shows you is that stock might be very risky in the short term over a 1-year period, because you could lose 50%. Historically, in 1 year, there was a year where you lost 50%. But in the long run, like I said, people have made over 10% per year. And so if you have a longer holding period, it becomes less risky because of the fact that it has some of the highest returns in history of any investment if you hold it for the long term. And so that's how you got to think about stock. If it's long-term money, it's a lot safer because it's going to have some of the highest returns of any long-term investment. But if it's shorter-term money, it could be very risky. And so you have to have the mindset that when you're putting money in stock, it's a longer-term thing that you might not access, for 20, 30 years. And if you have that mindset, you can do very well for yourself from an investing perspective. So what this chart is showing is every little rectangle you see has a year in it. And it's looking at returns over the past 151 years of the stock market, the S&P 500. And it's showing basically down here what the percentage returns range from. So if the percentage returns of the year were between 0 and 10%, it would be in this column right here. So in 2016, the returns of the stock market were between 0 and 10%. If you look at this column right here, you can see the returns were between 10% and 20% for that year. For 2020, it was between 10 and 20%. So just to talk through this analysis more in depth, you can see too, in 1931 was the year where the returns were, between -50% and -40%. And so how I like to think about this is we can see based off of the graph, there was about 97 years where the stocks were higher than 0%, where you got a positive return. It's about 64% of the time the stock market was up. But that also leaves 55 years, about 36% of the time, where stocks were down. So this shows how volatile stocks can be on a 1-year time frame. But if we go back to that analysis that I said, if we look at 30 years, the stock market does extremely well. And so Warren Buffett, one of the best investors of all time, he says, most people, the best thing they can do is to own the S&P 500 index fund, which is the largest 500 companies in the United States that are publicly traded, where you own their stock. The reason why he says that is, like I said, in the long run, if you just invest that and instead of trying to pick individual stocks, because the best investors of all time most of them can outperform the stock market. So if you can invest your money in the stock market and just let it sit there for the long run, historically, you've done extremely well. And it's not a guarantee, but it's likely that you'll do very well in the future because of the fact that that has done very well. You own companies that are growing their profits, and that's what stock is you get ownership in a business, and you own a percentage of some of the most successful companies of all time, which is why it allows your investments to grow at a very good rate. So to kind of wrap up the investment thing is when you actually go to put your money into like a retirement account, like a 401k, a 403b, or a thrift savings plan, a lot of times they're going to have what are called target date funds. So this is an example of a target date fund. What that means is that's the date they estimate that you will retire. And so let's say, I turn 65 in the year 2070. I'm going to be put in a target date fund, a 2070 target date fund, because that's when they anticipate me retiring, is roughly when I turn 65, 67 is the year that I would retire. And so basically the 401k company would automatically, most of them will automatically put you in a target date fund for the year 2070. And so what that's doing is about 54% of it is in the overall stock market, the S&P 500 that I just talked about. But then a 36% of it is in the international stock markets as well. Other countries have their own stock markets, so you'd own a percentage of some of their stock markets. And then on top of that, you would own bonds that are from the United States, and then a small percentage that are from other countries as well, which is, again, they return similar to savings accounts in the long run, maybe like slightly higher than a savings account, but think about it as putting your money in a safer investment, usually that will own slightly higher than a savings account. But what this fund does is when you get closer to the year 2070, it's going to become more conservative, meaning it's going to own more bonds. So by putting your money in this and constantly putting new money in it, over time, it's going to become less risky the closer you get to retirement. You don't want to be as aggressive with your investments because you're going to start pulling money out, and you don't want the stock market to be down 50% when you're pulling money out. And so the closer you get to retirement, the more bonds this is going to have, because those are safer investments in the short term. And so this is a great way to set it and forget it, meaning you figure out what's the date that you're going to retire. You put your money in it, continually put your money in this, and the fund itself is going to automatically change the investments for you to get more conservative the closer you get to retirement. And so this is just a very simple approach to not have to worry about what the investments are doing, because the fund is itself doing it for you. Now, when I was talking about one of the best investments in the long run is the S&P 500, one way that you could own that is through an exchange traded fund, an index fund. And so an example of one is the Vanguard S&P 500, and you'll have what's called ticker symbols, which are just short abbreviations for what allows you to invest in the fund. So that one would be VOO. So what this is doing is it owns the largest 500 companies in the United States that are publicly traded, meaning you can own their stock. But it's based off of the size of the company, meaning the bigger the company, the more you own. So right now, well, when I did this example, it said Apple represented about 7% of the overall stock market because Apple's such a big company. So 7% of your money would be in Apple. NVIDIA, which makes computer chips, 6.76% of your money would be in that because it's one of the largest companies right now. And then 6.25% of your money would be in Microsoft. And so basically what this does is it adjusts over time based off of how large companies are. And so the bigger a company gets, the more you own of that company. And so because it's automatically adjusting based off of sizes of the companies, you basically, it's a good representation of owning the US economy because these are some of the most largest companies in the United States, and it's a great way to own them. But the investment itself is automatically adjusting based off of how successful the companies are and how large the companies are. So with that, that kind of covers just some really high level stuff about how to go about investing money once you've been able to, let's say, pay off credit card debt. But I do want to talk about how people can actually go about having savings in the first place that they can go to invest. Because that's one of the most difficult pieces is actually people don't have any money that they're saving. So they can't invest that money. And so it's important to understand how you can save money. And I like people to guess what their highest expenses are. And most people will think, housing is going to be my number one expense. Transportation is going to be my number one expense. But in actuality, taxes are people's number one expense. And so it's important to understand a very small amount of the tax code here in the United States, because by understanding that, that's going to help you increase your savings rate. Because if you're, this is just a typical breakdown of where people spend their money, where the average American spends their money. And you can see that taxes by far are people's number one expense. One comment I'll make about this analysis is the debt. It goes into housing and transportation. And so there's a portion of that that's included in that. So if we just do the interest, it's below people's food costs and things like that. But that's also why debt is so important too. Understanding how to improve your credit score, which we'll cover later, is because of the fact that debt goes into a large portion of your overall expenses like housing, transportation, and education. But the number one expense that can get you the most savings if you get good at understanding that is taxes. And so this analysis right here is one of my best ways to show you actually how high your taxes can be and where your money's going when you actually have to pay taxes. So I'm looking at the average American household here based off of their income. And I'm looking at what happens when you tax $100 of that, like $100 that they earn. Well, they have what's called payroll taxes, which is Social Security and Medicare. They're going to have to pay $15.30 goes towards their payroll taxes. Then on top of that, you have what's called federal income tax. At the highest, at the income that the average person household's at, they're paying 22% on that. So they're going to lose $22 to federal income tax. On top of that, in the state of Georgia, your state income tax is 5.29%. So they're going to lose $5.29 to the state of Georgia for their state income tax. And then when you go to purchase something with that money, you're also going to be charged sales tax as well. So that $100 after taxes just turned into $51.41. That's a tax rate of 48.59%. And so that's why it's so difficult to save money here in the United States is we have all these taxes that we're paying. You don't see how high it is because, it's in different types of taxes, payroll, federal, state, sales. But when you account for all of the tax that you have to pay, you just paid 48.59% of your money towards taxes. And so if you can understand a little bit of the benefits in the tax code, this will dramatically improve your ability to save money. So, as I was talking about earlier, there's these accounts called 401ks, 403bs, and thrift savings plans. These are associated with your employer, so they're employee benefits. But you have the ability to contribute $23,500 per year into one of these retirement accounts. If you're able to do that, able to save that money, not only most companies will give you a company match, but that money can go in before taxes, meaning that $23,500 would not be taxed. You could also do Roth, where you pay the tax today, but that money will not be taxed when you go to pull it out. So with traditional pre-tax, it goes in today and avoids taxes, but when you go to pull it out in retirement, you are going to be taxed on that money. But this gives you dramatic tax benefits if you take advantage of it. On top of that, you have what are called IRAs, which is individual retirement accounts. They're not associated with a company, and you're able to contribute an additional $7,000 to it per year on top of the 401ks and the 403bs. And so by putting money into that, that if you do it traditional IRA, it avoids the tax today, but you're going to pay tax when you go to pull it out. With a Roth IRA, you pay the tax today, but you'll avoid the tax when you're taking it out. And so that's a great benefit as well. Lastly, there's these accounts called health savings accounts. They're usually associated with high deductible health insurance. So you would have to have a high deductible health insurance plan most of the time to get access to a health savings account. Employers will a lot of times do company matches into it as well, where they might match $500 that you put in. So if you put $500 in, they'll give you $500 into your health savings account. The key to these accounts, what's awesome with this, is the money goes in before taxes. It also avoids payroll tax, so you're getting an even higher benefit than a 401k. And you'll never pay tax on that money as long as you use it to pay for your healthcare costs. So these are some of the best accounts of all time. With the 401k, 403b, remember I said you put the money in, avoid tax today if you do traditional, but you are going to be taxed when you go to pull that money out. The health savings account will never be taxed as long as you use that money to pay for healthcare costs in the future. And the average American couple that is retiring today is expected to pay north of $300,000 over the course of their retirement towards healthcare costs. And so, that's in today's dollars. Imagine what it's going to be when you retire. So this is a great way to pay for healthcare costs in your retirement tax-free and save a tremendous amount of money by leveraging the health savings account. And on top of that, you can invest that money in the stock market. Usually how these accounts work is if you get the account above $1,000, they'll let you invest the excess money in the stock market. So the earnings can grow tax-free as well, and you'll never be taxed on those earnings when you invest it in the stock market, as long as you use it to pay for your healthcare costs. So it's one of the best ways to pay for your healthcare costs in retirement, tax-free. But you do it while you're young and healthy, and you can afford to be on a high deductible plan because you're not using your health insurance for, big medical issues that you're having. So you don't have to have a higher premium plan, and you can afford a high deductible plan. And so it's one of the best ways to start saving for your retirement healthcare costs is a health savings account. So with that, I like to kind of just talk through a few scenarios of the tax code to help you understand how to think about your personal situation, because of the fact that, it's good to walk through an example to see how to apply this to your real life. So I'm going to look at somebody that's making about $65,000 in their first job after Rollins to see what their tax situation would look like. Now, there's different situations where you could be married, filing jointly, or single, and I'm going to walk through a single analysis. With married filing jointly, you just multiply by 2 the numbers, and you have to account for your spouse's income. And so this same logic will apply for married filing jointly. It's just the income, the income limits will be higher. So right here in yellow, what I'm showing is the different tax brackets. And you also have what's called a standard deduction. What the standard deduction is your first $15,000 of income, you don't have to pay any federal income tax on. because of the fact that the government believes that that's the minimum amount of money that you need to afford life. And so they don't want you to pay any tax on your first $15,000 of income. But after that, any amount between $0 and $11,925 is going to get taxed at 10%. And then any amount that's above $11,925 up to $48,475 of income is going to be taxed at 12%. And so forth, meaning any amount between 48,475 to 103,350 is going to be taxed at 22%. So going back to this analysis of somebody that's making $65,000 and they're living in the state of Georgia where they pay 5.29% in Georgia state income tax. What is a strategy? What's the strategy they should do using these different accounts, the Roth IRAs, the traditional IRAs, the traditional 401ks? What's a strategy that I would look at doing for them? Well, first, I want to make sure they get as much money as they can into the health savings account, because that's the one where they'll never be taxed on that money as long as they use it for their healthcare costs. So the max amount they could put in per year is $4,300. Well, they're first going to get $15,000 of standard income subtracted from their taxable income. So that brings them down to $50,000. Then the first $1,525, they're going to save 27.29% on the Georgia state income and federal state income tax combined. And on top of that, they save 7.65% in payroll tax. Their company pays the other 7.65%, so that's why they're only saving 7.65%. But then after that, they now drop into the 12% bracket for the other income. So you can see right here, now their income is below the 48,470, so they're going to be in the 12% bracket. So that additional $2,775, they're only going to save 17.29% in federal and state taxes, and then 7.65% on payroll as well. But then since they're in a low tax bracket, 12% is actually historically a very low rate. I would recommend them looking at putting that money in Roth, because it's better to go ahead and pay the tax today when you know you're in a low tax rate, like 12% in the federal. So combined, they're at 17.29%. I'd say they would want to put, 7,000 into a Roth and 23,500 into a Roth 401k. Go ahead and pay the tax because they know they're in one of the lowest tax rates they might ever be in. So in total, they've only saved about $1,225 dollars in taxes today, this year, by doing that on the HSA contributions. Great tax savings. But their future tax savings are going to be gigantuan, because this money will not be taxed in the future on the Roths. And so that's one of the best benefits. But now I want to walk through somebody that's making a little higher income. What's a strategy that might make more sense? So I'm looking at somebody that made $98,275. They're still going to get the $15,000 standard income. That drops their income to $83,275. Well, that $4,300, that's still going to be in the 22%. That whole balance is in the 22%. So they're going to get 27.29% savings in the Georgia and state combined. And also they're getting the 7.65% savings on payroll tax. So they're saving $1,502 in taxes there. But now they're still in the 22% bracket on their other income. So I would actually look at doing traditional IRA, traditional 401k. 22% is a pretty high tax rate. And what happens is a lot of people, when they go to retire, their tax rate's going to drop dramatically. They're going to be at that 12%, or they might even be lower than that. And so that time it can make sense to go ahead and pull this money out then. And so right now we want to save on taxes today because we're in a higher tax rate. So anytime you're in 22% or higher, I kind of like to look at going the traditional route. And so they would look at doing 23,500 in the traditional 401k, 403b, TSP, and an additional 7,000 into the traditional IRA. That's going to save them in total $9,826 per year in taxes. So these examples just show you can get dramatic tax savings but the strategy depends on where you're falling in the tax brackets. It can be good to work with a tax accountant to try to understand this stuff so that you can make sure that you're putting money in the appropriate places. But general rule of thumb, if you're in 12% or below in federal, it's important to look at doing Roth, in my opinion. But in your 22% or higher, traditional can make a lot of sense. And so that kind of really covers it. So I want to bring a lot of these concepts together by looking at what somebody's financial picture might look like when they're starting out. They've been working a couple of years. This is a good example of what somebody's financial picture might look like. They might have credit card debt that's on average at 22%. They've got about $10,000 in credit card debt. They've got a mortgage at 4%, a 30-year fixed mortgage at $150,000. Student loan debt at 7%, about $25,000 outstanding, and an auto loan at 8% with $10,000 outstanding on it. But down here, they're making a salary of $82,000, a great salary. They can save about $14,000 per year, and they've got $30,000 tucked away in a savings account. On top of that, they have employee benefits of where they could have a house savings account where they match up to $500 contributed to it. And then they also have a 401k where they match up to 3% of the salary. 3% of the salary is $2,460. So I'm just going to talk through what this person should do. So right here, credit card debt at 22, but we know if they save this money and put it in the stock market, they're in the long run, they make about 10%. Well, 22% is a higher return than the stock market. So it pretty much never makes sense to have outstanding credit card debt because you're going to get the highest return on your money by paying off credit card debt. And they've also got $30,000 sitting in a savings account. They can afford to pay off that credit card debt at $10,000. So immediately what they need to do is take $10,000 and pay off their credit card debt. That's a 21% return on their money by doing that. You would think people would not do this, but I see this all the time where people feel like it's, they have more money than they actually have because they get to see what's in their savings account. But in actuality, it's not their money. It's the credit card company's money. And so it's better to go ahead and pay that off and get your 21% return on your money by not having to pay that interest in the future. On top of that, I would recommend looking at paying off the auto loan too. 8% return on your money is, yes, that's less than 10%, but that 10% is not guaranteed. Remember, some years it's down 50%. And in the long run, you might make 10% per year, but some years it's down 50%. I would rather get a guaranteed 8% return on my money by not having to pay that interest. So I would want to pay off that auto loan here too, because I have the money to do it. I can afford to do it. And that's going to be a very high return on my money. On top of that, I would put $2,460 in the 401k because that's a guaranteed 100% return on my money by putting 3% of my salary in the 401k. I'd also put $500 in the house savings account because of the fact that that's a guaranteed return on my money as well of 100% by getting that $500 in there. And so lastly, there would still be a little bit of money left over. You still want to keep an emergency fund, which is about 3 months worth of spending. And so, I estimate that the emergency fund would be $17,000. So you want to keep about $17,000 in the savings account. But after the additional $14,000 you can save, you could still put about $4,040 into the student loans right here. Because I wouldn't invest that extra money in the stock market because, again, a guaranteed 7% return, in my opinion, is better than a non-guaranteed 10% where the stock market could drop 50%. I'd rather take that guaranteed 7% by not having to pay that interest in the future. And so this is how I like people to think about their financial situation. You're going to have a lot of different priorities that you have to think through. So prioritizing pay off high interest rate debt, and also taking advantage of employee benefits where you can get 100% return on your money through matching is one of the best ways where you can increase your return on investment there. So I'm going to use the remaining time to talk through the importance of building your credit and building your credit score and the importance of utilizing debt. So as I mentioned earlier, debt is in so many aspects of your life, meaning that you're going to use it for housing if you decide to purchase a home. You're going to use it for transportation, and you're going to use it for student loans. But even if you go to start a business, you might need to take on credit card debt. If you decide to invest in real estate, you might need to use debt. And so by improving your credit score, you can have a dramatic impact on the cost of your debt. What I'm showing here is based off of your FICO credit score, which is the main credit score that people use, what's the interest rate you're going to pay on a mortgage. So if you're in the best credit score range between 760 through 850, your mortgage rate right now would be 7.24%. But if you're in the worst credit score range that would allow you to qualify for a mortgage between 620 through 639, your mortgage rate is going to be 7.84%. That's 0.6% higher. That may not sound like much, but in this analysis right here, I look at you buying a typical home in Atlanta, a medium-sized home in Atlanta. What does that difference come to over the course of that 30-year mortgage? I'm comparing the 760 to 850 credit score to 620 to 639 credit score. The difference in monthly payment is $474 per month of additional interest. Over the course of 30 years, that adds up to $170,520. So by making sure you get a good credit score on a typical home in Atlanta, if you go to take out a 30-year mortgage, you're looking at saving $170,520 over 30 years by having a good credit score. And so that shows why it's so important to build a good credit score. Now, what I'm looking at here on this analysis is what do current interest rates look like? We're in a high interest rate environment. So if we go back like 3 or 4 years ago, mortgages were at 3%. We're now in an environment where a mortgage is at 7.25%. And so right now it is more costly to try to own a home because debt is so expensive. And so right now it might not make sense to own a home. It might actually make sense to rent because of the fact that interest rates are so high. We may come back to a time where rates are 3% again, but right now it is extremely expensive to take out debt. And as I mentioned earlier, stock market return was about 10% per year. So right now it can actually make sense to buy a home with cash, which I know is very difficult to do because you would have to save up a tremendous amount of money. And so it can make sense to wait for interest rates to come down because of how high rates are. And so right now we can see prioritizing paying off high interest rate debt could be your best investment decision because even graduate unsubsidized loans are at about 8.8%. And that's a phenomenal return on your money by prioritizing paying that off instead of investing in the stock market. And so my most common advice right now, especially if you have some debt like this that is high interest rate, your best investment, because it's a guaranteed return by not having to pay that future interest, is to pay off that debt early if you're having a high interest rate debt. This is another analysis showing car loans. If you were in the best credit score range, you're looking at 5.8% for a new car and 7.41% for used car. Worst credit score range, 15.43% for a new car and 21.55% for a used car. So again, this shows how dramatically the interest rates can be different based off your credit score when you go to buy a new or used car. And so it's so important to have a good credit score. So how do you build a good credit score? That's going to be the number one question I get after I say that. Well, this is how the credit score is calculated. It's 850 is the highest score. It's calculated by FICO. And this is how it's calculated. 35% goes towards your payment history. 30% goes to the amounts you owe. 15% towards the length of credit history. 10% towards credit mix. And 10% for new credit. So what does that stuff mean? Payment history is they're looking at your past 7 years of payment and making sure you never missed a payment. And so setting your payments, all your bills on automatic payment is one of the best ways you can never miss a payment. And that will make it to where you could potentially get a perfect score on 35% of your FICO score. Now, what I want to stress about that is I said 7 years. So that shows that a lot of this can be time-based, meaning it can take a long time to build up your credit score. And so it's so important to start early. One of the easiest ways to do it is actually taking out a credit card. As long as you're responsible and are going to pay off your credit card debt in full at the end of every month, you do that for 7 years, that can build your payment history. And so I got a credit card when I was in high school. And by the time I graduated from college, I already had a really high credit score because I never missed a payment. Amounts owed, what that's looking at is based off of all the credit you're allowed to have, how much do you owe on it? So a good example, just to talk through a credit card, you could have a credit card with $10,000 credit limit. Well, if you have $9,000 on that credit card, that means you're utilizing 90% of that credit card. That's a big red flag, and that's going to hurt you on your amounts owed. But alternatively, let's say of that $10,000 credit limit that you have, you only borrow $1,000. You have $1,000 that you spent on it. You still have $9,000 of credit that you could take out that you didn't. That's a very low credit utilization. That means you're only utilizing 10%. So your amounts owed is going to be extremely high on your credit score because you're not utilizing a lot of your debt. Length of credit history, what that means is they're looking at how old your credit is. So meaning going back to my credit card from high school, I'm 36 now, probably had that since I was 16. So that's 20 years that I've had that credit card. That's a really old debt. And so that makes my length of credit history very good. But if I took out a new credit card, that credit card is 1 day old, that's going to really hurt me on my length of credit history because now I have credit that is very young. And so they're looking at all your debt combined, how old it is. And the older your debt is, the better your length of credit history is going to be. So it's important to not open up a lot of new credit cards all at once because now you're going to have really young debt and that's going to hurt you on your length of credit history. Also, when you open new debt, this new credit, they're going to run a credit inquiry. It could be called a hard inquiry. And if they do a hard inquiry, that's going to ding your credit a little bit. And so every time you go to apply for new debt, it can actually hurt your credit score because if they see you trying to apply for a lot of debt all at once, they think you're in a lot of trouble financially. And so that's going to ding your credit score. Lastly, credit mix is a mortgage is what's called an installment loan, where you have monthly payments that you're going to make. Student loans are the same way, where you have monthly payments that you're going to make. They want to see that you can handle that type of debt where you're going to constantly pay your monthly bill. Whereas a credit card, that's revolving debt, meaning that you don't have to take that money out. You have $10,000, you don't have to take that $10,000 out, but you could take $1,000 out. And so they want to look at having both types of credit and seeing that you're responsible with both types of credit, and that will get you a really high credit score. So with that, I know I covered a lot, and I see that there's questions in the chat. And so I want to go and focus on answering some of the questions that have popped up. Feel free to, if you have comments that you want to make, go ahead and unmute yourself, raise your hand, and we'll make sure that we get to your comments. So right now, I want to make sure we utilize this time to answer some good questions that we've either had in the chat or some questions people have that they want to ask right now. So.
We can start with one of the questions that was asked in the chat. So this is regarding student loan payments. Could you discuss the benefits of PSLF versus the Save Forbearance?
Yep, it's a good comment. So public service loan forgiveness is one of the best ways to get your student loans forgiven if you can qualify. So a lot of times you're going to have to work for like a not-for-profit organization to qualify for public service loan forgiveness. And you have to work there for about 10 years, basically. With save forbearance, a lot of times how the forbearance works when it's an income-based like forbearance, let's say. What that means is you've paid your student loans for upwards of 25 years before they can be forgiven. It's time-based forgiveness. Public service loan forgiveness, you can qualify for it in about 10 years. And so you're going to make less payments on your student loans because 10 years is way better than 25 years. On top of that, public service loan forgiveness is not taxable when it's forgiven after those 10 years. But with income, like a time-based one, like 25 years, with the income-based repayment plan, that is actually going to be taxable, meaning that you're going to owe taxes on the balance that gets forgiven. So let's say the government forgives $30,000 of student loans after you've made all your payments on the save forbearance. You're going to owe taxes on $30,000 of income. And so it's better a lot of times to qualify for public service loan forgiveness because of the fact, especially if you have high student loan debt. That's the key. Because of the fact that it's not going to be taxable when you qualify for public service loan forgiveness. And so that's the route that usually makes the most sense when I run the analyses. Now there's a lot of moving pieces based off of what your monthly payment's going to be. And there's really good calculators online that you can use that can help you determine what makes the most sense financially. I can't remember the name of the website right now, but anyway, what they do is they look at all the income-based repayment plans, public service loan forgiveness, and they help you to determine what's the best route for you to go. But a lot of times public service loan forgiveness will be the best route. So great question. Any other questions or comments there? I do want to make sure that I answer questions because I know that we covered a lot of material, and some of this stuff was very difficult, but I want to make sure that we ask clarifying questions that could help people. And so feel free to ask questions because this stuff, it can be a little complicated and it can be nerve-wracking to ask questions. But I'm sure if you have one, that means other people might have the same question and it could benefit a lot of people.
I have a question.
Yes, sure. Go ahead.
Is there a way to contribute to a Roth IRA if you're over the income limits? I know you didn't discuss the income limits associated with these accounts, but is there a way?
Yeah, it's a great question. There are income limits to your ability to be able to contribute to a Roth IRA or even a traditional IRA if you have a employer retirement account. So meaning if you have a 401k, that's the key. One way to get around it, there's this thing called a backdoor Roth. And you need to make sure you don't have any traditional IRA balances out there because it could be a taxable event if you leave money into a traditional IRA. But assuming you have no traditional IRA balances, what you would do is you put your contribution into a traditional IRA. And because you can't take the deduction because your income's too high, you can convert it to Roth. And because you never took the income deduction from your traditional IRA, that is not a taxable event as long as there's no other traditional IRA money out there. And so they call that the backdoor Roth transaction. And that's how really wealthy people at high incomes get money into Roth IRAs if they're not allowed to. And
So just
so
to understand, like, I can't have like a set traditional IRA that I'd like leave a job and take with me, but I don't want to touch that. But there's money if I want to still contribute in my Roth that I had set up. To put money in there, I can't just leave that account alone and open up a new account just for the sole operation to backdoor into Roth.
yeah, it's a good question. And the reason for that is how the tax rules work. We're talking about a complicated tax section in the IRS tax code. But basically, when you leave money into a traditional IRA, they consider that a taxable event. And they'll tax it based off of the percentage of money that stays into the traditional IRA. So, if you had $100,000 in a traditional IRA, and you put that $7,000 in, the bulk of it, 93% of it would stay into the traditional IRA. So 93% of that, money that's converted into the Roth IRA is going to be taxed basically, is how the tax rules work. And so, what some people do when they're in too high of an income, like you're talking about, to contribute, is you can actually roll over that money into like a 401k. And then because it's no longer in an IRA, then you can do the backdoor transaction the following tax year. You can't do it in the current tax year because there was money in a traditional IRA. It's a pretty complicated process, to your point, and it's silly. It's a government rule, unfortunately. But that's one of the only ways you can do you can do the Roth. And it's just because the government, that's how the government wrote the tax law, unfortunately.
Okay. So just to be clear, if I'm just rolling over a portion, it's just a difference of I can leave it there, leave the traditional funds in there or whatever they are, and then roll over a portion, just pay whatever tax on, knowing that they're taxing me on the whole thing, whatever to that amount was.
But I would tell you, I recommend against it, to be honest, because it basically, in theory, you're going to be double taxed. And what I mean by that is when you go to get that money from your employer, you get taxed on it through your payroll process, where they're going to withhold federal and state income tax. But then on top of that, when you go to convert a portion of it to Roth, you're going to get taxed on that again. And so you basically are causing yourself to get double taxed. So the Roth IRA is not beneficial to you if you have a traditional IRA. It's just better to leave that money. You have what's called an individual brokerage account. That's an account where you can invest in the stock market, and the earnings, you won't be taxed on the earnings until you go to sell the stock. And it has favorable capital gains treatment because as long as you hold it for over a year, you get a favorable tax rate. And so it's more beneficial usually for you to not do not do the Roth transaction, because you're going to get double taxed. It can make more sense for you to basically put it in a single brokerage account in your name, invest it in like the stock market, and you'll get taxed on the dividends, a very small portion of it. But it's going to be favorable capital gains treatment, and that's usually the better route to go, instead of getting double taxed through that backdoor Roth transaction. So if that, I know that we were talking about kind of a complicated scenario there, but I just want to make sure like that's kind of would be like what I look at doing in a situation like that. So, and great question. Any other questions or comments there?
Ciara Scott has their hand up.
Yeah, thank you. Can y'all hear me okay?
Yes.
Okay. So I have a question. Well, first of all, like I really enjoyed this presentation, so thank you. This has been really helpful and I've been learning a lot. I missed like the first maybe 5 minutes or so I didn't hear if you gave a background on like what your role is. So I don't know if you're like a financial advisor or how you kind of got into this space, but during the presentation you mentioned like when you were talking about taxes, like you recommended getting a like tax accountant to help you figure out some of that stuff. And so I was wondering if you like recommend, well, first of all, if there's like a difference between like tax accountant and a financial advisor, or like can a financial advisor help you with similar things? And then if you recommend like kind of a everyday person to get a financial advisor, because I feel like, yeah, this was helpful. I learned a lot and the things that you were saying were making sense, but I also like don't know if I could figure out like those calculations you broke down for like somebody's salary and how to go about, putting money in different things, like if I would be able to simply figure that out for myself.
Yeah, that's a great question. What I will say is I am a financial advisor. I will say the problem with the financial advising industry in general is that they usually will not help people unless you have a lot of money. And so that's why I like to teach this stuff to people, is because it is very difficult to get help unless you have a lot of money. A lot of tax accountants, the problem with them is they just want to get all your tax forms and they're going to plug in the information into the tax form and then submit your tax return on your behalf. But they actually won't do a lot of tax planning for you. Sometimes they will. Also, financial advisors, a lot of them don't understand taxes, unfortunately. Now, a really good one should. I have an accounting background, which is why I understand it. But I would just tell you that a lot of people don't. But what I'm pulling up here on my screen is I typed into Google Smart Asset Georgia State Tax Calendar. And what you can do is actually put your income in here, and they have an advanced section where you can put like your 401k contribution, your IRA contribution, whether you do itemized deductions or not. That's a different story, but the minimum amount of deductions you get is standard. Itemized is if you have more deductions. Most people on this call will only have standard deductions. So you can put that information into here in your filing tax status and determine actually what your tax rate is. So let's say you're earning $70,000 in your household income. Then it will shoot out right here what they anticipate your effective tax rate would be, and your marginal tax rate. And this basically shows where you're falling in the tax bracket. So the marginal tax bracket is where you care about if you're contributing money to like a 401k. And so right now they're at 22% marginal tax bracket. So this calculator is a good analysis that you can look at too, if you want to try to have a calculator help you figure out the answer if you can't find a good financial advisor or tax person to help you. And then you can just put the 401k contributions in here too. So let's say 10,000, and it will adjust. And now you'll see the marginal tax rate is 12% because they had such a huge contribution to their 401k. It dropped them down into the 12% tax bracket. So this calculator is a good one, a good resource to use too if you can't find a helpful person, like a helpful financial advisor. Last thing I'll say to your question though is, so like financial advisors at my company, a lot of times they will do financial planning sessions with you for free. And so there are some advisors out there. Now they're hoping that you're going to invest lots of money, and most of them will turn you down because if they know you're not extremely wealthy, they're not going to even do a financial planning session with you. But some newer financial advisors, they will do it with you, and they'll do it for free as well. And so sometimes you would have to call up a lot of financial advisors to see if you can find a newer one that would work with you. If, when I say a lot of money, usually they want you to have at least north of 100,000, but a lot of them want you to have north of $500,000. So,
Okay, that's helpful. And this resource that you shared, is it only for Georgia, or could I go to the same Smart Asset and look? Because I actually live in North Carolina.
Yep. Yeah. Good question. Yeah. So what you would do basically when you do the Google search is you just do Smart Asset Tax Calculator, North Carolina.
Okay.
And so you just put whatever state that you live in, you just put that in the Google search and you should be able to pop it up. And then you can get it based off of North Carolina as well. I do default to Georgia because a lot of people stay in Georgia.
Yeah.
To your point, there's other people from other states, and you just have to put the name of the state in there, and it should pop up the correct state calculator for you.
Okay, that's helpful.
And the last comment I'll make, though, is it's usually 1 year behind. So, right now we're in 2025,
okay.
so it's based off of the 2024 tax year. But once we get to the 2025 tax year, which is, beginning of next year, it'll be 2025. And so, it's going to be off maybe slightly because it's using, last year's tax brackets. But it's a really good estimate. And so it's one of the better ways to estimate it. So,
okay, that's helpful. And one last question I have for you, because I work for the state of North Carolina, and we have like a pension program instead of, I guess, like a 401k. And does that make a difference when you're trying to calculate stuff? And I just started, like, I've been here less than a year, and when I started, it was kind of a whirlwind. So I just know I got enrolled in that pension program automatically, but I don't know much about it, but I know it's not a 401k. But does it make a difference when you're trying to figure out your savings stuff?
Yeah, it's a great question. So, how I like to think about pensions from a retirement perspective. First off, there's a couple different things you got to think about. Some pensions, they make it to where you no longer get Social Security benefit because you pay it like you're paying into the pension instead of paying into Social Security. And so it replaces your Social Security income. Uh, Other pensions, you pay into Social Security, and on top of that, you get the pension benefit as well. And so you need to understand, based off of your county, based off of your state, what type of program they have, because that has a tremendous impact on you. Because
Okay.
otherwise, you're either getting, two income streams where you're getting Social Security and your pension on top of Social Security, or you're just getting one income stream, which is going to be the pension income stream. And so how I like one of the easiest ways to figure that out, I mean, you can ask, the human resources department of where you work to figure that out. A lot of times they'll know the answer, but you can log on to the Social Security website and get a statement and see if you're paying into Social Security. You can also look at your pay stubs, and a lot of times they'll show you paying into Social Security as well. If you're doing that, that usually means the pension is separate from Social Security. And so what I like to do with the pension is you can usually project based off of how long you work there, what income you're going to get. They might give you basically your full salary, like what your salary was when you're retired. And you use that to estimate if that would cover your expenses in retirement. So let's say your expenses are $50,000, but your pension's going to be $50,000 per year. That means that your pension's going to cover all your living expenses in retirement. Now you're still going to have inflation where those costs are going to grow over time, and your pension may not have inflation. So you still need to, invest money so that you'll have enough money to pay for the growth in costs that will occur over your retirement. But the amount of money that you have to save would be tremendously less. The best way to do that math is, so there's what's called a safe withdrawal rule. And I like to say you can safely withdraw 5% of your investments. And so basically, if you were to, I'm trying to see if I can pull up an analysis here because I think I have it. So just give me one sec.
Okay.
Oh, I don't have it on this one. But basically, you take your spending and you figure out like how much assets that you would need to have to get that spending level. So let's say you have $1 million in assets. If we just multiply it by 5%, that tells us that you can safely spend $50,000 per year in your retirement because you have $1 million saved. And so whatever the gap is in your spending that your pension doesn't cover is how much in assets you would need. So if you needed, let's say $10,000 basically, that means you're gonna you would just take 5% of take the 10,000, divide it by 5%, and that shows that you need $200,000 basically to make up for the $10,000 of income that you're not getting through your pension. And so that's a simple analysis you can do to try to figure out how much assets you need to save when you have a pension like that. So,
Okay, that's really helpful. Thank you so much.
yeah, great question. Thank you.
Hey, I don't see any more questions in the chat. I did see a question that asked resources for where we can learn more personal financing. I think the calculator that you just shared hopefully helped to answer that question.
Yeah, one thing I'll just add to that is there are some really good books out there that kind of cover what I was talking about. So I'll Teach You to Be Rich by Ramit Sethi is a really good book. So I'd say that's a pretty good starting point. Actually, the Personal Finance for Dummies is one of the best personal finance. I've read probably hundreds of personal finance books, And as silly as it sounds, the Personal Finance Book for Dummies is probably one of the best books I've ever read on personal finance. And so, but I'll Teach You to Be Rich is a more entertaining book, but also great quality content. So I would say those are some really good books to read if you're looking for good content to consume. So
Thank you. Um, yeah, I don't think there's any other additional questions. I think one question that I'll just plug in lastly is you did mention that it taking out a lot of new debt or opening credit cards kind of close to each other is not a good sign. How spaced out do you recommend people open new lines of credit?
yeah, it's a good question. So it depends on when you need debt, is how I would phrase it, meaning that um, if you open up a lot of new debt, but you're not going to need debt for a long time, then it can be okay because it still represented a very small percentage of your credit score. And if you need that debt, in the short term, then it's okay to go ahead and open up a few different types of debt. Where it gets you in trouble, though, is if you're going to need additional debt after that in the future, because by doing too many debts all at once, that's where it's going to really hurt your credit score. And so that's how I like to think about it. Now, if we go back to the analyses that I was doing, where I was showing you basically here, the credit score ranges, those are the key. Meaning if you were to drop from 782 to now 661, now you're in prime. If you go from 782 to 601, now you're in non-prime. And so you want to make sure you stay within those different categories. Unfortunately, we don't know the exact amount you're going to drop because they won't disclose that. FICO has a way of calculating it, and they're not going to tell you exactly how they calculate it. But we do know new credit is about 85 points of your credit score, but also length of credit history is about 128. And so, you can make sure there's, Experian has on their website, they'll have ways where they might estimate how much your credit score would take a hit depending on what you do. And that would help you figure out roughly where you're going to fall, where your credit's going to get hit. And if you're going to jump to a different credit category, like prime or non-prime. And so that's the key, is making sure you can stay within those different categories because that's going to have a dramatic impact on your interest rates if you end up taking too big of a hit. So it did look like there was a question on traditional and Roth IRA. You can have both, but you cannot contribute past the $7,000 per year. Meaning you can do 4,000 in traditional, 3,000 in Roth, but you can't do 7,000 traditional IRA, $7,000 in Roth. You can't do over the $7,000 limit. So it's a combination of $7,000 between the two, and that's the key. And so the deciding factor, like I said, is where you're falling in the tax bracket range. So if you still have a portion of your income in 22% or higher, you could do a portion in traditional IRA. And if you and then put the additional portion in Roth IRA, if that makes sense for you. And so that's kind of some of the thinking I would think about related to that. So.
Thank you. I think that is all the questions for today's session. Thank you so much, John, for joining us and giving us such an informative and helpful session for everybody. And thank you all for joining us, and we look forward to seeing you for future sessions. Thank you.
Perfect. Thank you.